Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again Danielle DiMartino Booth. Danielle is a frequent guest on CNBC and Fox Business, sometimes on Bloomberg as well. She is frequently seen, at least when I tend to see her on television, it's when the Fed is about to make some decisions on interest rates or whatever else they're up to, and Danielle is sought after by the mainstream media for her opinions because she has had a background in the Fed, having been an assistant or an aide or an advisor actually to Richard Fisher of the Dallas Fed in the past, and during a very tumultuous time, of course, after the 2008 financial crisis. So we're really privileged to have Danielle with us. Thanks for joining me again, Daniela.
I'm happy to be here today.
I'm happy to talk to you from what you saw, the bug splattering Texas. A very interesting article that you put out today, Bug Splatter Season Just Over the Horizon. I want to ask you about some of the content of that article. It's obviously an eye catcher. I guess I should tell our people this is DiMartinoBooth.com is where they can go. That's your website. You have a couple of very, very informative, I think very useful services. One is a daily and one is a weekly. Can you tell our listeners just a little about your service before we get started?
Oh, absolutely. And DiMartino Booth is kind of my personal website. It's been around for a very long time. The better of the two, however, really is my company that I formed called Quill Intelligence, quillintelligence.com. When I rolled out, in addition to the weekly that I've written since leaving the Fed in June 2015, last Memorial Day, I rolled out the Daily Feather. And that's what you're referencing right now. And it's kind of my first retail product, if you will, because the institutional one that I'd written for years really wasn't able to be accessible to the masses. It wasn't as affordable as I would have liked it to have been for people who had read Fed Up and wanted to be able to keep following what I write about. So it's quillintelligence.com. Have a look. And we've gained a cult following in a very short period of time. You've seen both the weekly and the daily.
Yes, I have. And I would say, looking at the daily, if you want to really keep up with what's going on in the market, on the financial markets, I don't know of anything better. And you always have a very good graphic that you start your article out with that I think is very, very positive, very helpful to me for sure. I'd like to begin by asking you to summarize, if you don't mind, Richard Fisher's monetary philosophy and how he thought the Fed should have behaved or responded to the 2008 crisis.
Well, I think that and I should clarify by saying that it was heresy at the time that we suggested it. But Richard and I were always of one mind that the Fed could have stopped at 2% on the Fed funds rate, that there was no requirement necessarily that the Fed go to the zero bound in order to make monetary policy as loose as possible. The real issue, the real challenge that the financial markets faced around the time that Lehman melted was the fact that liquidity had frozen. And it was, in fact, the liquidity facilities that were rolled out by the New York Fed, not quantitative easing, that ended up facilitating the reopening of the capital markets and the stabilization of the banking system. And again, they had nothing to do with the price of credit, with the interest rate going down to the zero bound, a move that we argued really did begin to introduce all kinds of distortions into the financial markets that we're still dealing with to this day.
I would guess so. I mean, after all, if you don't allow price discovery of capital, how can capitalism survive?
Well, that's exactly right. I am an avid proponent of price discovery, unfettered price discovery, the ability of the markets to do the job that investors need for them to do. And, it's literally, just to give you an ounce of history, in the aftermath of the crash of 1987, Alan Greenspan started leaking information to bond trading desks ahead of Fed moves to inject liquidity. And that is the birth of the Greenspan put. So it's been well over 30 years now that markets have become reliant on being spoon-fed information about Fed moves before they even take place, kind of as we saw with Jay Powell's recent interview on 60 Minutes.
Yeah, maybe, and actually, I guess maybe now's a good time to mention, I think you wrote an article that is available. Is it at Bloomberg, or an article about
yes.
Jerome Powell's 60 Minutes interview?
Yes.
Is that available to the general public?
Piece. Oh, absolutely, yes. It's a Bloomberg opinion column. I'm a full-time Bloomberg opinion columnist in addition to everything else I do because I don't need sleep. No, I'm kidding. But it did just hit the wires, and it was written in reaction to not only Jay Powell's 60 Minutes interview, but as we look to March 15th and the 10-year anniversary of Ben Bernanke's 60 Minutes interview.
You do a lot of tweeting, too, and I appreciate it. I follow your tweets on a regular basis, and I thank you for that. Your thoughts are out there all the time. With regard to Chairman Powell, when he was named, you were pretty positive about his appointment. What did you see about him that caused you to look favorably upon him?
Well, I was, at one point around this time last year, the founding member of the Jay Powell fan club. I had heard his first congressional testimony at which he said that it was not the Fed's job to backstop the stock market, that investors should have to deal with the consequences of taking risks when they made investments. And he had also, on his very first day in office, suffered several days where there were quadruple-digit declines in the Dow Jones Industrials, and he didn't react. He didn't send out a press release like Greenspan or Bernanke or Yellen would have done. He stayed calm, and the message to the markets was very unfavorable. And I'm not trying to say that I want for people in the stock market to lose money. That's not my point.
Of course.
But at some point, we're going to have to cut this umbilical cord where the Fed comes to the rescue every single time the stock market moves just a little bit. But as they say, Jay, that was then. Things have changed.
So, I mean, yes, the screams of Jim Cramer or whoever else on Wall Street, the babies cry and they get their milk. That's been going on for a long time. And yet, the problem that I see, Danielle, is that things keep getting worse because we never address the underlying problem. We just keep papering it over. And we keep pumping money into the system, and we don't really ever allow the debt to be adjusted downward so that it's more in line with GDP. And it just, I mean, I don't think you need to be a PhD in economics. If you look at a chart and see the exponential rise in debt relative to GDP, you kind of figure this can't go on forever. And yet, hardly ever talked about, outside of yourself perhaps, on mainstream television. I guess the party continues as long as it can until something breaks, huh?
Well, that is the basic idea, but we have to sit back and look at the bigger picture, in my view, because think of the headlines that we're looking at today. We're talking about just flashing on Bloomberg headlines is that Ted Cruz has just retweeted Elizabeth Warren's Facebook tweet. There's kind of bipartisan support for antitrust movements against some of these monopolies. Well, guess what? A lot of that has to do with Fed policy.
Sure.
If you don't take the deadwood out of the system, you end up with two consequences. One of which is that you have lots of walking wounded zombie companies. My good friend Jim Bianco tracks these companies, and we've never had this many walking wounded, walking dead companies in the midst in the United States. But it also has investors gravitate to kind of never fighting the Fed. And the biggest manifestation of never fighting the Fed is the rise of monopolies through the power they've been given by indexing. The index is on the S&P 500, the index on the QQQs, on the NASDAQ. Yeah. The bigger the market capitalization of these stocks grows, which it naturally does mathematically via indexing, the greater their power is, and every time there's an innovator that might be able to rise up and bring something new to us, they're simply absorbed by Mother Microsoft or by Google or Amazon. You know what I'm saying.
Mm-hmm. Yes, absolutely. It's massive amounts of malinvestment that are created by huge amounts of money that is just perpetually pumped into the system, it seems. Let's turn, though, to the economy now. I mean, do you think... So are you saying that Jay Powell probably he capitulated to the cries of to the pressures from Wall Street? Is that the way you see it?
Well, I do and I don't. I don't want to defend Powell, but I will tell you that this is the man who, in October 2012, these are in publicly released with a 5-year lag, FOMC transcripts, worried out loud around the table at the FOMC that the Fed was inflating a duration bubble across the full span of the credit spectrum. Mm-hmm. This is a man who has deep roots in private equity, and I think more so than just the stock market. I think what frightened Jay Powell and what made him appear to bend to the will of the stock market, and I've been very critical since the Powell pivot, I think what scared him more was his deep understanding of the credit markets, which are a lot bigger than the stock market, and the fact that issuance in the junk bond market towards the end of last year went into a deep freeze we hadn't seen in years. You know, you can talk all about complacency in the stock market and a low VIX all you want, but if the credit volatility genie is released from her bottle, all hell will break loose, and Jay Powell understands that. I think he saw it late last year.
You know, and more than the stock market, it's that fear of the unraveling, as it were, akin to 2008, 2009, perhaps, huh?
Right, and as you know through my work, the quickest evidence that we see of the damage that's wrought is in pensions putting in their worst quarterly performance in the fourth quarter. And Jay Powell understands that there are certain things that Fed policy cannot address quickly, and kind of the state of Illinois melting down would be one of them.
Oh my goodness, yes, yes, just to name one. Well, that was back on January 10th when the pivot, or let's say, you call it the pivot. Jay Powell, when he sort of seems to switch gears. You tweeted, "I'm flummoxed by this man I once had faith in." And Powell has lost his credibility in the eyes of many market watchers. I would say yes. It seems like the Powell put is in place then, huh? It seems to be.
Yes, it does. And, again, I understand what drove him, and I understand what spooked him. And, it's rational. You can't just sit back and say, well, the global financial system is about to melt if this continues. But because he has to be responsible in his position, and we have to respect that.
Yes.
But it was the way that he went about it. The fact that he got up on stage with Janet Yellen and Ben Bernanke, two individuals he'd been critical of for a good portion of his career at the Fed, whose policies he had rightly called into question, such as that last iteration of quantitative easing, which Jay Powell, again, back in 2012, said would become, quote unquote, habit forming. So why he couldn't have been a little bit more honest with the public, why he continues to maintain that the economy is on as strong a footing as it is, it smacks of hypocrisy, and obviously angered me enough to tweet out great big words like "I'm flummoxed."
Yeah. I mean, but I just have to wonder who in their rightful mind would ever want that job, at least at the current point in time when the financial system is such a mess. It's like, who would ever want to be president of the United States, for goodness sakes? You're damned if you do and you're damned if you don't. In his case, as you point out, he has to be responsible with respect to the financial markets. And I was just thinking, when he sort of changed his rhetoric, I just thought, wow, I can kind of understand that. Who would want to be blamed for the next financial crisis, right? I mean, the pressures are enormous on him.
Oh, I'm not unsympathetic to what Powell faces. I never was. I always said that, critics from day one were saying, he's going to be just like them. He's a shill, blah, blah, blah. And I would always defend Powell.
You were always defending him.
At least he was willing to step up. At least somebody was willing to step up into, this morass that's been created by his predecessors in 30 some odd years of too low for too long. I don't envy him in the least, and I think that the only thing that Fed policy can do at this juncture is buy time.
Yeah. All right. So, I mean, things have changed. Looking at your bug splatter article today, you talk about an environment in which you seem to be concerned that the economy is already slowing down, and inflation, or we're likely to have disinflation, if I read your article correctly. Is that your take now, that things are not so good, really? And certainly you can't pay much attention to any president. They're always telling you how great things are, even as the Titanic is slowly tipping upward and heading down. But how do you see the economy now? What's that?
Well, look, yesterday we saw, Quill Intelligence ran an analysis of the Richmond Fed, the New York Fed, and the Atlanta Fed, and their GDP models a few months back. And what we found was that, of course, all models are going to have flaws, but what we found was that the Atlanta Fed had the most accurate of all trade records. Well, yesterday, when the stock market was up big, celebrating presumably what it thought was a huge rebound in retail sales, it was respectable and it was broad-based. But once you combined yesterday's report with the slowing momentum that was actually revised downwards in November and December, you had the Atlanta Fed come out yesterday afternoon and reduce their first quarter GDP estimate to 0.2%.
Wow.
I think you call that unchanged and very, very close to being a potential negative print, which the markets are not anticipating in the least. But lo and behold, as we wrote last night, if you're starting to see deflation in goods, that tends to be a leading indicator, the same way that manufacturing turning tends to lead the rest of the economy, even though it's predominantly services. And so what we were saying was, if retail sales are slowing in the good sectors, in the durable sectors, then the market could be setting itself up for a surprise on the core, which indeed it was. You've seen headlines all day long that say, gee, the core inflation came in at 0.1%, half of what was expected. Well, guess what? You read it before it happened in Quill this morning when it was released an hour and a half before the data. But again, that's what we do. We try and get in front of trends by following history's leading indicators in order to figure out where we're headed. And right now, we see the economy as slowing down, and slowing down rather quickly.
Yeah, well, it certainly seems to be. In the reading your article, really, certainly not something they're going to broadcast very often anyway on the mainstream media, where they have to keep the party going, I guess, right? So it's
got to keep dancing.
Yeah, keep on dancing, and the orchestra keeps playing on the deck. I wonder to what extent. I mean, we've heard the rhetoric. Do you think that the Fed are they really tightening now? I mean, David Stockman's been on the show. He's been convinced that the Fed isn't going to loosen up, that they're going to continue to tighten, or at least not be accommodative. But I mean, there's one thing to hear the rhetoric, and there's another thing to get under the numbers, as you're able to do, and figure out what the Fed is really doing as opposed to what they might be saying. Do you have some sense of that now?
Well, I think that what the Fed is trying to do is you cannot pull the plug. You can't wake up one day and just say, we're going to quit quantitative tightening tomorrow. We're going to quit, we're going to stop shrinking the balance sheet immediately. These are the things that send shockwaves through markets, and they're actually counterproductive from the Fed's perspective. Fed policy is rolled out as a process, one step at a time. Jay Powell has informed us that the Fed is looking at how it will stop quantitative tightening towards the latter part of the year. That came out in the most recent press conference, and that was reiterated again on the 60 Minutes interview on Sunday night. And this coming meeting that's coming up next week in the statement, as well as the press conference that follows, I think we will see him outline what it will take to stop shrinking the balance sheet by $50 billion a month, which is continuing on in the background. As the economic data continue to weaken, that is what is going to give the Fed cover to truly stop quantitative tightening, which I believe will happen here within the next few months. People have to remember every $250 billion or so call that every 5 months, quantitative tightening equates to a quarter-point increase, a quarter-point rate hike in the Fed funds rate. So the tightening is definitely going on in the background, But again, I think Jay Powell is methodically informing the markets that this is going to come to an end before 2020 rolls around.
Yeah, I think that's why your daily quill is so helpful, I think, in helping those of us who aren't as intimately involved with the markets as you are. I really think this is a must-read for people who really want to try to stay ahead of the market and be early and not, learn about what's happening when it's too late to do anything about it. You had mentioned, I think, today the retail inventory to sales really rose very dramatically, I think, in the most recent month, right? Most recent reading.
Yes, and inventories are definitely becoming problematic, especially in the automobile industry. And one of the things that we've picked up on is in June 2017, for example, when we saw a similar ramp up in car inventories, manufacturers came out and announced that they were going to be cutting production. And along the way, they increased incentives to try and clear out the inventory that was sitting on dealer lots. Well, it's funny because Wall Street's so focused on the profit margins of General Motors and Ford that this time they've been completely stubborn about it, and they've been reducing incentives, which we think is setting the markets up, especially in the auto sector, for a big surprise when they don't even bother to reduce incentives. They just cut to the chase and reduce production.
Interesting. So we'll see what happens. So in light of this weakness, though, I mean, there would be real economic reasons for Powell to lighten up too, to ease up a bit.
Well, yes, and that's, I mean, at the risk of contradicting myself, I've been saying this for a very long time. He just needs to be forthright and recognize that the economy is slowing as opposed to trying to be or appearing to be a cheerleader. He didn't bring up the fact that the manufacturing sector is slowing in the 60 Minutes interview. He didn't even allude to residential real estate and how much it has slowed despite mortgage rates coming back down. I would just it would just appear better, I think, if he was able to recognize rather than react to the economic data in his position.
With just a few minutes left here, what are the chances of a recession this year? Might be pretty good.
The chances of a recession this year are very, very high. Ned Davis Research, which is no fly-by-night outfit, a few weeks ago they said that the probability of a global recession had risen to 96%. My buddy Dave Rosenberg up at Gluskin Sheff, his global recession probability is at 80%. Wow. If you look outside the United States borders, there is no such thing as permanent decoupling. At some point, with 41% of S&P 500 revenues tied to overseas revenues, at some point we will succumb to international pressure in addition to what we already know is happening domestically in pockets of the economy.
Let's help our listeners that understand what this might mean then. If we have a slowing economy, I would imagine bullish for the bond market, bullish for treasuries. I would imagine, I don't know about the equity market. If they keep pumping money into the system, who's to say it won't continue to, or at least won't, I don't know. What are your thoughts on the equity markets in this view, given this viewpoint? Let's say we enter into a recession. Normally you would expect profits to decline and maybe equities to decline along with profits, but not necessarily. I think it has more to do with money flows, right?
It absolutely has everything to do with liquidity, and the reason that a recession will threaten the stock market is because one of the main sources of support and liquidity last year was nearly, $1 trillion in share buybacks, and they've come out of the gate at a record pace in 2019. Well, that is not an option that companies have. If we go into recession, investors will demand that they clean up their balance sheets and that they prioritize that in front of share buybacks, and there goes your liquidity. And again, Federal Reserve policy is a process. You cannot roll out quantitative easing overnight.
All right. What about gold and some of the commodities I don't know about, but gold would seem to be possibly, if the Fed starts to pump money into the system, would be bullish for gold, possibly.
One would certainly think so. I mean, a full disclaimer, I personally own gold, and I know I'm the furthest thing from a gold bug you'll ever meet, but I do find it to be the ideal portfolio hedge in both deflationary and inflationary times, I think one of the least understood aspects of gold is how much it has outperformed in these deflationary scares that we've had in recent years.
Absolutely. We'll have to leave it go at that, Danielle. Thank you so much for being with us. It's your insights are really greatly appreciated. I hope we can have you back again sometime soon. Thank you again for being with us.